No straggling.
All right, cool. Good afternoon, everyone. Welcome to our final webinar of the year. My name is Samantha Brennan. I'll be the moderator for today's webinar. This session is going to run for about an hour. Any questions you guys have, just drop them in the Q&A box at the bottom and we'll address them as we go. Before we start, a quick disclaimer. This presentation does not provide legal, accounting, valuation, or tax advice and should not be construed as such. It's for informational purposes only, and examples are illustrative. Please do not distribute these materials without KLG's consent. And that's all for me for now. Dave and Joe, floor is
All
yours.
right. Welcome, David Gralnick. That's Joe Ammirati. We're going to be doing a seminar today on introduction to business valuations and valuing professional practices. So, as Sammy said, if you have any questions as we go, just please feel free to type them in, and we will answer them as we come to them, and as we see them. So we've already read the disclaimer, so we don't have to go with that one. So we'll move on. So here's the agenda for today. We're going to identify and define businesses that should be valued or can be valued, I guess. We're going to talk about the 3 approaches to value. We're going to discuss IRS Revenue Code Ruling 5960, which is basically the Bible for us. We're going to talk about the different methods under each approach to value, a basic understanding of each approach and each method. And then we're going to discuss valuing professional practices. And again, at the end, if there's any questions left over, we can talk about those. And you guys can feel free to email them to us. So first off, identifying and defining businesses to be valued. So at the outset of the case, if one of the parties in matrimony owns a business or an interest in a business, that should be identified. So what do we consider a business? A traditional business that sells goods and services. We always give the example of widgets, because we all like back to school. So widgets are a great, easy one to utilize. Professional practices, which is what we'll be talking about today. Medical practices, law practices, accounting practices. Obviously, there are some others, but those are the 3 main ones that we see all the time. Single person consulting business, which most of the time appears on a Schedule C. Real estate holding companies, management companies. For the real estate holding companies, obviously, we would need real estate appraisers to do appraisals of those real estate holding companies if possible. And then investment companies, hedge funds, investment advisors, private equity. Those are the main types of businesses that we see all the time. Those are the ones that, really are the ones that we value all the time. And obviously there are others, plumbers, things like that fall under different types of, professional practice or traditional business or something like that, they mix sometimes. But, obviously, if you guys ever come across something and you have a question, you feel free to call us and we'll let you know our opinions on it. Moving on. So what are the 3 approaches to valuing a business? So first of all, let's talk about the components of a business value. There are 2 main components to a business value. The first one is the tangible value or the equity. That's basically the book value of the company, the assets of the company. So the cash, the receivables, the fixed assets of the company, the less any debt, accounts payable, things like that. So that's the tangible equity value of the business. And then there's the goodwill value of the business, which is basically the value above and beyond the tangible value. The name, what's that bring to it, things like that. So, you talk about Coca-Cola, obviously you're talking about the name itself, the goodwill is the majority of the value in something like that. In the smaller businesses, that's not always the case. Very often, a lot of it is the tangible value. But, we have to look at both portions of that when we do our valuations. So let's talk about the actual 3 approaches to value. First approach is the cost approach. That's generally used for businesses that are substantially based on the tangible assets, real estate entities. Those are the main ones, that you look at. So, it's things that where the assets are the main value of the business. So if you own a building in New York City, that piece of real estate is usually going to be the main source of the value of the business, which is why, as I stated earlier, you'd want to get that appraised. The second type is the income approach. It's a value based on a multiple of future income or earnings based upon the risks of the business. So we always tell you that, or if you've ever spoken to us with regard to a business value, that it's a future looking model. It's based on the future income or earnings. It's not the past. We utilize a lot of the times the past as a guide for the future, especially if, we always ask for projections or something like that. But if they're not available, then we have to look to the past as a guide for what the future will bring. And then the third approach to value is the market approach, which is the value based on sales of similar businesses. Could be a public company, could be private companies, but they have to be somewhat comparable. For instance, restaurants. There are restaurants bought and sold all the time, bars, things like that. There's a lot of data on that we can find on private companies that have been sold. So if you're buying or selling if you're looking to value an Italian restaurant, you look towards those things, and you can find hundreds of sales of Italian restaurants, in the last few years, and you can look in the area. There's various ways to look at that. And then if you have a larger type business, you can look at public companies also. So we do that as well. So those are the three basic approaches to value. Joe, you have anything to add?
No, I'll do a deeper dive on each of these three, Nick, and I'll
Coming up.
Right.
Okay. So then we talk about the revenue ruling 5960. And as I said, this is kind of the Bible for us. This is, talks about, what we do. So the purpose of the revenue ruling is to outline and review in general the approach, methods, and factors to be considered in valuing shares of the capital stock of closely held corporations for estate tax and gift tax purposes. The method discusses herein will apply likewise to the valuation of corporate stocks on which market quotations are either unavailable or such scarcity as they do not reflect the market value. So when you hear us talk about, 5960, a lot of the times that's, the excess earnings method. But this gives you, that's the basis for it, but it gives you the further guidance on what you're looking for in valuing the stock. And it talks about fair market value, which, the price at which the property would change hands between a willing buyer and a willing seller when the former is under no compulsion to buy and the latter is under no compulsion to sell, and both parties have reasonable knowledge of all the relevant facts. Those are key words, no compulsion. So, they're not forced to buy it or sell it. They have knowledge of all the relevant facts. That way we know what, someone is going to pay when they look at what the actual income stream is, what the actual revenue stream is. Same thing with, the person who's selling it. Obviously, they're going to know that. So they have more of a knowledge of the reasonable relevant facts. But, if they're a minority owner, they may not have that knowledge. So if they own a small percentage. So that's something that, we always look towards this fair market value standard. Then we're also going to be talking a little bit about value to the owner, because when we're doing professional practices, obviously you're looking at a lot of personal goodwill. But so we look at the value of the owner, and that's defined as a value of an income stream that provides an economic benefit to the owner that may not be transferable. So when you guys, sell your law practices, that economic benefit may not fully transfer to the other person because a lot of it's based on your personal goodwill. So we talk about the value to the owner. So that's why we look at the income stream and value that income stream as a multiple. And we normally take fairly low multiples on those because of that personal goodwill issue. And that's for New York. just to, let's go back, sorry. And just to throw in, if there's anyone from a different state or Connecticut as an example, if they're doing marital dissolutions in Connecticut, personal goodwill is not transferable. So, law firms are not really even valued, especially one person law firms, because there's no transferability of that, income stream. So, we look at that, because it's based upon the person's reputation and skill. So we don't really value those. But, in New York, we look at value to the owner. So I just wanted to throw that little nugget in. And again, that's something, if you ever have questions on, you can feel free to let us know. So, Joe, I think you're up.
Yep.
So take it away.
This part of the presentation, I'm just going to do a little bit more of a deeper dive into the three methods we just previously discussed on valuation and when each is applicable for the valuing a subject company for an assignment, whether it's tax or litigation purposes or management planning. The first, again, is the cost approach, or sometimes referred to as the asset approach. And what that typically is, you would utilize this approach, as David said, if you do maybe like an asset intensive business, such as a real estate holding company or investment holding companies, where its only purpose is to hold assets and has really no operations. I mean, even though a real estate entity could rent out, rent has income based, the real estate appraisers are going to take that into consideration. Us, when we're valuing the equity, are going to just look to the asset value of that and amongst the other assets of the business and the liabilities. Again, this also can be used for liquidation proceedings. We sometimes refer to this as the floor value or the minimum value, that the business might have. If it has, again, if it's assets minus liabilities, has some equity, that would be the presumed value or the floor value, but that's under the cost approach. The main method we do under the cost approach is the net asset approach. And this is basically, like I said, if using an example of a real estate holding company, we have XYZ Company LLC owns a piece of property. So besides the value of that asset, on a tax return of financial statements, that's going to be reflected at the cost basis. So that's really just if they bought the property 20 years ago for $1 million, that's what's going to be reflected on the financials and tax returns, along with accumulated depreciation against that asset. So the tax return to financials, when you look at that at face value and the value of the asset, you always have to remember that's maybe at the cost basis, that might not be at the market value. So what we do is, that's why we ask for appraisals. We'll adjust out that value for the market value as of the valuation date pursuant to that appraisal. Sometimes it could be a crane company or an excavating company that could have multiple major equipment assets. We would do the same theory, swap out the cost for the market values based on an appraisal provided by an expert in that field, and that would be reflected on a balance sheet. But we're also going to look at the other assets and liabilities of that LLC or holding company, such as cash, or any other maybe marketable securities it might have. So there might be other assets of value besides the real estate that we might need to consider in valuing the equity, again, interest in that company. So let's say it's for a matrimonial, someone has a 30% interest in this real estate holding company. We want to figure out their pro rata market value first before then figuring out the fair market value. But we're also going to look to making sure that those assets that are reflected are at market values as well. So the cash account, does it confirm it to a bank account balance? If there's marketable securities, again, are they at cost basis, or do we usually get a brokerage statement, look at the value of those assets and put that on the balance sheet? Confirm debts that are on the company's balance sheet. Is the mortgage debt, as of that date, what is that debt? Is there any other debts and liabilities that should be considered, or even contingent liabilities? To ultimately get to that final equity value. So it's the market value of the assets minus the market value of the liabilities will give you that market value of equity, which then we will calculate the percentage pro rata interest and then effectively take discounts. So that's the basis of the cost approach and why we say it's more for asset intensive businesses.
And just to, we're not going to talk much about discounts today. That's its own full, webinar. So if people have interest, in something like that, at the end, when you fill out the thing, just, put in that that's something you have an interest in, and, we can get to that one next year. Okay,
So we can move on to the income. Okay, so the next approach considered by valuation analysts is the income approach. Again, this is, mentioned in revenue ruling 5960. It's when the earning capacity of a business being valued is to be considered. A lot of times, basically what that means is the value of its cash flows is greater than the value of its assets. That's the cash flows that are generated by this operating company, in this case, would have value above and beyond its assets. So the certain methods we consider under the income approach, first is the capitalization of income of cash flows. So what that is basically, we're looking at the reason why we ask for 5 years historical financial information typically is to utilize the past to try to figure out what the company is going to do going forward. Many small companies don't prepare projections, or their management's not sophisticated enough to, have that crystal ball to figure out what their future income is going to be going forward. But, as analysts, we look to the past to try to help figure out that as well for them. Figure if the past is up and down every year, maybe an average is applicable. If it's on an upward trajectory of income and growth stage, maybe the current year is more applicable. So under the capitalization of income method, we're analyzing the past year's, operating history and financial history of the company to figure out what we're going to use now in what we call a single period. Take that, what we're going to call, future expected cash flows, and then apply a capitalization rate, which is based on market-based rates of return. When we're going to value a business, you want a safe investment, you're going to put your money in treasuries, so we call that a riskless rate. That's one level. But if you want to put your money into the stock market, it starts getting a little bit riskier. Looking at blue chip stocks, you're going to expect maybe a 10% return. So, and then from there, okay, what if I want to invest in small companies? There's more risk involved. So what it is, this capitalization rate is a buildup of layers of risks and rates of return that we're seeing in the market to ultimately compare to our subject company. So the analyst will develop a capitalization rate based on these risk factors, size, public company, then there's specific company risks involved, reliance on, key customers, management, economic factors. So effectively we come to this capitalization rate, which we divide into that, income stream that's been growth adjusted. Now the discounted cash flow method is basically the same principle, but here management or the owners are providing us with a projection of their future cash flows, maybe 5 years out, 3 years out. We as analysts will, vet those projections. We'll see if they make some economic sense before just blindly utilizing them. Maybe they're, showing small growth, but when historically they had tremendous growth, or vice versa. There's pie in the sky type projections that we maybe have to smooth down a little bit, that they were prepared for, a specific purpose, but now for our valuation assignment, we have to really have now economic reality factors come in. Can they achieve those projections? If they had projections in the past, did they achieve those same levels in the past that they, projected versus the historical? So in the discounted cash flow, we're looking at those future projections of cash revenue and cash flows and calculating the present value as of the valuation date. Again, this time we'll call it a discount rate, but it's the same thing as our capitalization rate. Just to give a quick tutorial, the difference between a discount rate and a capitalization rate is just the growth factor. So the first levels of adding risk for riskless rate, size premium, specific company risk premium, that brings you to a discount rate. So and you utilize that rate, but if you're going to do a capitalization of earnings, you subtract out the projected growth. So sometimes you hear that risk. Some people get confused when they hear discount rate here, and they think discount on valuation. Two separate things completely, but unfortunately using the same term.
right. And just so everybody's aware, these are after-tax cash flows or
Correct.
income, not pre-tax, because all the public companies are based on and the rates are based on after-tax numbers.
Yeah, so we're matching apples to apples. We want to make sure the rates of return we're using are after tax, and we want to make sure we're applying that to after-tax income. A third method we consider is the excess earnings method. Now, this is, frowned upon by some in the valuation field because it's not really a sound experience, but value and professional practices in New York State, some divorce cases, this has become a known method. But it's basically a hybrid method of the asset approach, which I just previously talked about, of course, and the income approaches. Whereas On the asset approach, portion of the excess earnings, this ties into revenue rule in 68609, where they're trying to say, okay, what are the tangible assets of an entity? It's cash, it's assets minus its liabilities. So we called it net asset value before, but in excess earnings, sometimes it's referred to as the net tangible assets. Things that can be sold and liquidated and monetized. If there's things on a balance sheet like goodwill, that's an intangible asset that's usually not considered. But then we're also going to look at the cash flows that are generated. So again, the same cash flows we've calculated maybe in the capitalization of income or discounted cash flow method, the capitalization of earnings method. That same level of cash flows minus reasonable comp to figure out the true profits of the business. We're going to reduce that for a rate of return basically against the assets it has, and that's based on prime rates. Just basically, if I had that 300,000 of tangible assets, if I was to invest that in the market, a reasonable return or a bank statement return I can get is maybe 7-8%. So that gets subtracted from the cash flows, and then a goodwill multiple is applied to arrive at the goodwill value. So the two components under an excess earnings method is looking at the tangible value plus the goodwill value will give you basically your indication value of the company.
Right, and just to go back to the other two, unless there's some kind of non-operating or excess cash component or excess working capital component, that equity is already included, or the tangibles are really already included because you're doing an equity value. So that's the entire company. So that's why when you see the capitalization of income and cash flows and discount cash flows, we don't add the tangibles then to the goodwill, because what we're figuring out is the entire value of the company, the equity of the company. Whereas when you do the excess earnings method, by putting the tangibles and non-tangibles together, you're getting to that equity number.
Yeah,
So
and that's a good point that Great Dave makes. And when we're analyzing the cash flows, we're doing everything to try to figure out the operating value of an entity under these methods, under the income approach. So what that means is if there are things on the balance sheet like non-operating assets, excess cash, they like to hold, instead of distributing, they're holding 5 million of cash on their balance sheets. A typical business that's being bought and sold might not need to keep that same level. So once we determine whether a reasonable level of cash is to cover working capital expenses, add on to that value of these methods might be these non-operating assets, or if it had marketable securities that's not relevant to operations, or personal assets that might be on the books. Maybe they keep their boat or their cars. Those now will be add-ons to our value. But when we're doing things under the income approach, and the same thing with adjusting the cash flows for non-operating expenses, we try to figure out the operating value. And then if there's anything non-operating, usually get added on, tacked on to the back end of that value. We can move on to the market approach.
Yep.
Okay. So the market approach is basically, the theory of the market approach is the valuation is it's the economic principle of substitution. One would not pay more than one would have to pay for an equally desirable alternative. Therefore, when we seek valuation guidance for prices of similar companies to what we're valuing, we look to the market. As Dave mentioned, maybe restaurant valuations. We subscribe to multiple databases. There's transactions in the market. You can go on Google, look for certain businesses that are being bought and sold, pizza places. What are these people trying to sell their businesses for? And then calculate maybe the effective multiple. So if they're grossing $1 million in sales and they're listing it for 500,000, I could say their value is 50% of their revenue. Is that the indicated value I should use to my subject company? I don't know, but let's compare that to what we see in the market based on other transactions of information. So, we subscribe to these databases that track that information, and that's really what we call the private, traded companies or private transactions method. So under these, databases, which are usually coming from business brokers or banks or sources of information, it might list out, hundreds of thousands of restaurants, all different types. And we as analysts have to, sift through all that data, find things that are more relevant to our company, apply those multiples, see what kind of multiples will get kicked out. But that's basically under the private transactions method. That's the applied method many of our experts do here. So we look to see what that, generates. The other method that's done under this is the guideline company, transaction. So unfortunately, when valuing small companies, they don't have a public company comparable. But some cases, if it's a certain industry and it does have, like auto dealerships, there are public company auto dealerships out there. like companies like Penske, that maybe we can look to see what these public companies are trading at. Look at the stock prices, look at the trends that are going on. What multiples are they yielding of price to revenue, price to EBITDA, price to cash flow? And are those now applicable and applying to our subject company? Revenue ruling 5960 strongly advocates that, analysts look to the guideline company method when doing a market approach. But that's only because back then private transaction databases didn't exist. I'm sure if they wrote that same revenue ruling today, they would say, listen, look to transactions in the market, because this is more relevant to the standard of fair market value. Like Dave said, willing buyer, willing seller. So if two parties are transacting, transactions enacted, then we can utilize maybe those multiples as a good proxy of value. One thing also that can happen is sales of stock in the company itself. Maybe we have a large company that has multiple stockholders, and there's been some redemptions of prior stockholders, minority interest. How did they redeem their stock? What did they get paid out on? Was it arm's length? We're also going to want to look to some of those transactions internally in the company to see, maybe that's an indication of market value pricing that we should look at or consider when we're valuing these companies. It's important that, for the analyst to always make those inquiries, again, do these searches, even though if it's a niche business, sometimes there might be, there's tax case laws where I think it was the Gallo case with the wine, there's not many public company wine companies out there, but you compared it to other beverage industries, and the IRS said, you know what, you can do that, even though it's not the specific, wine industry, but there's parallel companies that operate under the same, distribution channels, customer bases, product development that might fall in line with that, and maybe the analyst should consider those. But because basically anything in the market is considered objective. That's it can be tied to some sort of financial analysis.
Right. And as Joe said, transactions within the company, somebody sold their interest for a certain percentage, or a certain dollar figure, what did they sell for? Why did they sell it? You got to look at all those reasons, but it may be a very good indication of value for this company. If it's within the last, if it's 28 years ago, it's probably not going to care. But if it's, within a reasonable time period of when you're looking to value the company, then it's something that should definitely be considered.
And sometimes we always look to the, operating agreement or the shareholders agreements, because sometimes they might have provisions in those agreements that are, again, might not be indicative of fair market value, but we need to understand that they say, well, anyone who wants to redeem their stock is going to get 2 times their prior year's average earnings. We need to be aware of that. What was the basis of coming under that? And if prior stock people were being bought and sold under that, and there's a history of it, then yes, there might be some relevance to utilizing the same method, because this is how true minority shareholders do get monetize their interest. So again, looking to prior transactions, but also what's in the agreements or in the corporate documents should be, relevant. I mean, there's advantages to this, especially for guideline companies. Advantages are, again, it's relatively objective. It comes from the market looking at public companies. But the disadvantages, in doing like these public company transaction methods is, there's lack of comparability. Again, there might only be 2 companies. Is 2 companies relevant versus 10 companies? There's also swings in the market pricing, during COVID, or, certain trends or, effects, a valuation date, as of the date during that same time, the market could have been in shambles. Is that artificially lowering the values in the multiples at that specific date versus the averages a year prior? And then, of course, information only as good as the information provided or, from these public companies. So we can only utilize what's being, publicly shared.
So now we're going to talk about steps for valuing professional practices. Joe, you're up first.
Sure, I'll start with a small practice. So in this example, we're going to walk through, we're going to be, discussing a valuation of a small medical practice. So, typically when we're valuing small business interests or small medical practices of, now that's especially today with roll-ups, it's a little bit more, interesting, but we're going to look to, normalize the balance sheet of the company. Again, look at the assets and liabilities that are being presented, figure out all of the operating assets, see if there's any non-operating assets that we need to consider or adjust for, If there's anything on the balance sheet that needs to be, maybe adjusted upward or downward, like, from like marketable securities might need to be adjusted upward, but things like, is the receivables listed on most private practices, they might be on a cash basis on their balance sheet. So what that means, it's only going to reflect the cash balances. It's not going to have accounts receivable listed, accounts payable listed. In medical practice and private practices, that becomes a significant asset, and that should be accounted for in our valuation, since again, we're trying to figure out the tangible values. The theory being, if the practice shut down on a certain day, it's owed money. What is that money it's owed? Can they collect on it? Is it 100% collectible? 90% collectible? Does the receivable reports showing, gross billings before adjustments or reimbursements? So these are things that we want to look to. Also, when we get a balance sheet, make sure payables are listed, or if there's any accruals that need to be adjusted, we want to factor that in. We want to come up to the tangible assets as of the valuation date. Similarly, we're going to look to the, historical incomes. Most medical small practices are not going to have projections. So again, we're going to look at the past year's operations, income, expenses, and profits, and try to normalize that income or adjust it. So similar to almost like, think like an IRS audit. We want to clean up the books. Maybe there's some personal expenses we need to add back, or make compensation adjustments for the doctor. If the doctor's on a Schedule C, they're not going to pay themselves a salary. They reflect the profit. So we're going to need to impute a compensation, or they are paying themselves either above and below market. We're going to need to adjust those cash flows for reasonable compensation of that, individual or individuals for their similar services they provide. So if we're valuing an internal medicine doctor with, 20 years experience, we're going to look to statistical research of internists with similar experience, maybe in the Northeast region, metropolitan area, or again, certain online publications that are going to show what doctors at that skill level are being paid in the market, and then reduce that income for that level to arrive at the, again, normalized income of the profit of the business. So, if the company is showing 500,000, we subtract out reasonable comp of 300,000. Now the profits are 200,000. And then we're going to base, now we're just going to understand the risk of that medical practice. Is it location? Is it clientele? Are they dealing with a more senior, clientele versus, and hasn't, how often do they get new patients versus what's the attrition or the decline in patient roster? I mean, how's their office conditions? Are they bringing up associates? Is it a solo practitioner doctor? So we got to assess all these different risk factors in valuing the small business.
Okay. And then we're also going to talk about large law or large accounting firms. The main differences between that are, first of all, instead of looking at profit and losses and tax returns, we're usually just going to get K1s because, you're not going to get a tax return for, Sterling and Sherman and Sterling and huge law firms like that. So we get the parties K1s. We look at the income trends for those. Obviously, we try to look at, a number of years to try and predict what's going to happen, but we're also going to look at distribution schedules and things like that. We're going to understand the capital that they have, the difference between permanent and non-permanent or undistributed capital. Permanent capital is going to remain with the firm, so it's part of the value of what they have. But the undistributed capital, that's really an asset of the parties because it's going to be distributed either shortly or would have been distributed already. So you don't want to count it twice. So the undistributed capital would come out. We're going to subtract reasonable compensation. In large law firms, it's easy, easier sometimes, but we always ask for what the other highest earners that are non-partners are making in the same, region or the same office and the same industry. So if you're doing a tax partner, in a law firm, you ask for what the highest paid non-partner or associate slash, associate is making in the tax group in that office. So you have an idea of what other people in the firm are making. You're not just going to use that, though. You're going to obviously check it against statistics like we would in the smaller firms. And then again, we're going to pick a multiple based on various risk factors. Those multiples are, usually on the lower side just because, you can't really sell your interest in a large law firm. You know, we always do look at agreements as well for that. If there's an agreement value upon death or disability or upon leaving, we usually add that as one of the or not one of the factors, but we'll put that as in a scenario for everybody to consider. So moving on, we're going to show you an adjusted balance sheet, what it looks like. Joe's going to talk a little bit about more because this has to do with the smaller firms.
Right. I apologize for those who might be visually challenged like myself, that's very small. But we'll try to walk through it. So again, the column that says unadjusted 2022, again, that's information, again, just so for your purposes, you know, we take off of the tax return or financial statement as presented to us. So, you know, as of, let's say we're doing a valuation date close to year end. So we were utilizing the December 31st, 2022 as our proxy for the value of assets. So the question sometimes could be is, well, what if I have like a September action or an August action? Of course, we try to get that information and adjust for it. You know, we'll look at the cash accounts, the bank accounts, maybe make adjustment if the balances in those months vary. But most small businesses do not prepare balance sheets in the normal course of business, you know, monthly or quarterly. You know, they do their balance sheet at year end when their accountant comes in and figures everything out. So it's not uncommon that sometimes we have to use like the prior year's balance sheet or the balance sheet closest to the valuation date as a proxy for the tangible assets as of the valuation date. So for this purposes, let's assume our valuation date is the same, December 31st, 22. So again, we're going to start with the reported balance sheet on the tax return. But like I said before, that's maybe most are going to be based on a cash basis. So we have to include certain assets like accounts receivable. And what we do is we include accounts receivable net of taxes. Because the theory is that, you know, if they're going to collect those receivables, it's going to be part of their income. It's going to be tax, you know, affected. They're going to have to pay taxes on it. So we impute those taxes to make the adjustment for the net after-tax value of those receivables. And we'll do testing of those receivables to make sure does it make sense. Most medical practices have a, you know, a 15 to 30 day collection period now versus in the past it used to be much longer. But now with everything online and insurance companies moving a little faster, reimbursements have gotten better. So usually receivables aren't as grand as they used to be. So sometimes is there a sanity? Does it equate to 1 month or something? You know, like we can tie into is there an accounts receivable report the practice can generate. You know, some of these medical practices might have a billing, outside third-party billing coordinator or internal billing department that should be able to give us that, you know, information. Of course, we spelled accounts wrong. My apologies on that.
I think it was me. Sorry.
But yeah, that's the adjustment we'll make. You know, then in here, you know, they weren't including certain assets, you know, and liabilities, you know, whether it was maybe medical equipment. So we made that adjustment for the depreciation of those assets because they might have straight lined it, write them all off, and we says, listen, you know, that's good for tax purposes, but in arriving at what the maybe a medical equipment or is worth, let's look at what you historically bought and apply a straight line depreciation against that to figure out what the salvage value is. I mean, maybe you can't sell it dollar for dollar, but let's make that adjustment. Maybe there is some value in the market for these equipment, but just to ascribe that those assets help generate the cash flows, we got to put them in the balance sheet.
Sorry.
Yeah. And then, of course, you know, we're going to adjust for the liabilities. You know, here they had, you know, certain business related assets or liabilities on there, like credit cards. If we went through and it said, okay, we took out all the personal junk off it, or they had other credit, adjustments that might be needed, we will adjust those liabilities either upward or downward. In this case, for example, we did a downward adjustment to remove non-operating liabilities. So ultimately, that just gets us to what we said. Like I said, the two components of an excess earnings value, because this is where we get a small medical practice. That's the methodology we're going to apply here. You know, if we were just doing a cost approach, the value would be 80,000. That's what we're saying, you know, before discounts consideration. That's, like I said, is the floor value, the minimum value of this medical practice. But it's got cash flows, it's got profits, which we'll walk through next. So the next step we said is, you know, let's normalize or clean up the income statements. So again, we're looking at the historical revenue, this practice who's doing 565, 612, 585. So pretty static, pretty leveled, you know, revenue generations. Similar to profits, it's reporting, decent profits, because they maybe do, this could be from a Schedule C, they weren't maybe paying themselves salary, so all the profits are being reported and taxed. But there were some additional adjustments we would make, for some personal expenses, like maybe the car and travel, if it's a single office, where they're driving to. There might have been, some legal and professional fees. Maybe they started paying their divorce attorney, or, that last year and we adjusted back, or the experts. We'll add back things like interest because we knew that there was a lot of non-operating liability. So any interest that was relating to that got adjusted for. And then we'll look at things, like I said, the depreciation. If they use accelerated methods on a tax basis, sometimes you'll hear like the Section 179, they bought $100,000 of equipment, they'll expense $100,000 that year. It has tax benefits, yes, but for our purposes to figure out the normalized value, income, we want to smooth it out or straight line it. Because the theory being that the depreciation expense every year, if you buy $100,000 equipment, and then every 5 years, if you depreciate it, you have to probably replace it. That $20,000 a year of depreciation would reflect the reserves you might need for always, updating equipment. So we would reduce it for straight line and reduce that income for that depreciation under the assumption that they need that to reinvest in the business. So once we do all that, we figure out our, pre-tax earnings before reasonable compensation. Again, this is a doctor saying, okay, historically he's made 434, 409, 400,000. So going forward, based on that 3-year average, because there's ups and downs, they'll count for good and bad years. We're projecting that, his revenue going forward should be 588,000 as a reasonable benchmark. And then his income before reasonable compensation projected should be about 413,000. But like we said, we have to now figure out, what the profits of this business was. If this doctor was to hire an associate, that associate or doctor steps in his or her shoes, performs all the services to generate these profits, they would need to pay that individual, $276,000. So it's the salary plus the payroll taxes that would be charged. So at the end of the day, if this doctor's profits in his medical practice are $137,000 pre-tax. And that's what we're going to utilize now in our valuation. So again, under the mechanics of the excess earnings, we're going to include the value of those tangible assets we talked about after adjusting for the receivables, the asset value. Then to figure out the goodwill component, we start with the $137,000. Again, that's the cash flow after reasonable compensation. That was the remaining profits. We're going to subtract from that a reasonable rate of return on the tangible assets. Like I said, if the doctor was to take that $80,000 and invest it in a safe investment, or some corporate bonds, junk bonds, or prime rate, lend it to somebody, 8.5% as of the 12/31/22 was a reasonable rate. So you subtract that from the cash flows. That's basically, again, the rate of return on those assets.
I remember there were high interest rates back then. So.
Yeah. So that brings you to your pre-tax excess earnings. We would tax impact it. Here we're using the personal rate taxes, for that individual, because it's, again, value to the owner theory we're working under. Apply a multiple of 5 times, it's just based on our research analysis, our subjective parts, the good and bad, ugly of this business practice, to arrive at the goodwill value of about 404,000. So in combined, take the 80,000 of tangibles plus the goodwill component, is the fair market value of that, interest in that medical practice.
No, really I mean, it's really not necessarily fair market value. I guess I wrote it as fair market value,
Yeah.
but it's the indicated value, I
Yeah.
would say, is probably a better word. So ignore the fair market value, just because, again, we're using value to the holder here, more so than fair market value, because these things are not so easy to buy and sell sometimes. So, because a lot of professional goodwill, which we talked about. So moving on, we're going to talk about the large law firm, the excess earnings method. So we're going to look at the net tangible assets. This is the permanent capital, okay, of the person who you're valuing. Okay, you're only valuing that person's interest. Okay, so you don't have to go through 100%, 20%, all that stuff. 0.01%, It is what it is.
You
This
don't
is
actually
their,
tell them how they get to that number, how they find that number?
all right, so when you're looking, you got to look at the K1s, okay? And sometimes the K1 will have it. It depends if it's an S corp or an LLC, okay? But a lot of the times we get this directly from the company. We ask for it, a breakdown. And even if you don't, you still have to get a breakdown of the capital because it's permanent and undistributed, which we talked about in the past. So we're going to get a breakdown from the company. Then the year-end distribution schedule and the K1s showed that, you know, they were making $1.725 million. Okay. Remember, you were talking about large law firms. Reasonable compensation for them was 750,000. This was based upon essentially the highest paid non-employees of the firm. So you had, you know, in their region, in their industry. So we looked at that and we took that at 750. So that gave their pre-tax adjusted earnings was 975. The mechanisms that we just used in the small law firm now are basically the same for the large law firm. You're just throwing it through the same 68609 excess earnings method. So you tax impact it, you get your adjusted earnings before the tax. Your multiple here is 3. Again, can't really sell your interest in a large law firm. So this multiple is really has to come down even more so. You have your goodwill, which is the 604 times the 3. And then you add the 2 together to get to your indicated value of $2.122 million. So if you look at the two, they're very similar. Okay, it's just how you get to your net tangible assets and your pre-tax earnings on a small law firm or small firm are much different than on a large firm because you have to look at different things. Obviously, one of the things on a large law firm, which we talked about, agreement value. If there's an agreement, we would put that in as well. We didn't really want to, you know, go through that because there could sometimes it's 4 different machinations of it. There's, you know, you have to stay for 3 years and then for 10 years and then disability and then upon death. And there's, you know, there's all these different variations. So we didn't want to get into showing all those different variations that are possible because they're so different. But you do, you know, it's something that we would consider. It's something that we would look at. It's something that we would advise the attorneys of as well.
One thing I just want to add, you know, even though we're saying
Yep.
small and large firms, sometimes I think that's more relative to the interest being valued. So, I mean, what's relative a small firm? Like maybe it's a $20 million firm, but if we have a partner, and I guess this is the question, it's only a 1% interest partner. Would you still value the full company and figure out his 1% interest? Or would you do the mechanics of the large law firm interest, saying this is a 1% owner, she earns what they earn, this is their capital account, this is their balance. Maybe that's the effective method, is doing the same theory as we do under a large law firm, because they're not going to have access to the books and records of the companies, or they don't control the cash flows. So usually when we say like a large law firm interest, we're kind of really talking about a minority interest in a practice, because, you know, again, a 1% owner in a $20 million company, you know, it's probably the same as a, you know, fractional interest in $1 billion law firm. So it's the same theories involved. So that's where we try to like utilize the same methodology theory. But
Right.
you know, and then what, you know, when we're doing these, let's say we're doing a law firm in a Simpson Thatcher or these other large law firms, again, we're not going to value the whole company, figure out what their 0.3% interest is. This is why sometimes we just streamline it down to the K1 information, the capital balances that's in there. You know, each of these partners, they got sophisticated now, they might have, go online and look up their partner statement to get that capital balance, that permanent capital balance, and provide us that information. Look at the K1s, figure out their distributions and income, or what the management committee told them their income is for the next year. So these are
Right.
all relevant questions that should be asked when you're dealing with maybe more of a minority interest owner in these firms. Is, you know, again, what information is provided to you? You know, when you, is your income based on any formula? Is it based on your generations? Is it based on originations? Or does the executive committee every year just tell you, you know, this is what you're getting this year? Tough beating.
And are you on the executive committee? Are you on the compensation committee? Those things, you know, they have a bearing on these things as well. So you have to find that information out also. Does anybody have any questions for us?
No, I just have one question, topic that's been raised recently, especially like with maybe accounting firms or consulting firms is now, someone mentioned, so what about private equity deals that are going on in the marketplace? Again, going back to the market approach, we will look at those and see if they have any sort of, relevance to the subject company we're valuing. Because someone could say as well, we just saw that, CBiz took over Markham and they paid a gazillion multiple for that, so my now small practice is worth a gazillion times,
I don't think it was a gazillion, but
Yeah, but that's where we're trying to figure out, again,
right,
look
we
into
see
the
that more
market
and
approach,
more.
what's the relevance? Because sometimes the question's gonna come up. I hear there's medical practices with the roll-ups, that are going on and consolidations that are going on into the market. Even though we do these other mechanics and an income approach, I feel like we're slowly teetering now back to the market on certain these transactions. Again, looking at what these things would be, is this a short-term trend? Do they have any justification, these multiples that are being thrown around, or or these acquisitions that are going on in the market? Because a lot of them, even if they're, buying this interest out, they might have, earnouts and long-term employment agreements that these people might be subject to, and they can't monetize their interest for another 5 to 10 years until liquidity event. So there's a lot of factors out in the market that we have to consider as experts. And, that's why you hire, experts like us to go through that information, navigate those issues, flush them out, and provide you now with the appropriate value for the subject company interest.
But not only that, but when talking about that, I know now some of them are, you get a portion up front and then you got to stay for 4 years to get the next portion. And, those are all things that have to be considered in. So, it's, our jobs are getting harder and harder with all these new, these new private equities investing in all these companies, medical practices and things like that. We do have a question. How does one determine what a reasonable multiple is when valuing a small law firm practice? Well, you can't really, there's no right answer to that, but it's literally so many things go into it. But you're looking at, the size, you're looking at how key those people are. You're looking at how many different people work there, how many, are there 10, are there 20 doctors, or, or lawyers or whatever? Are there 3? Is one customer a large portion of their, their income? There are a lot of factors that go into that. So it's not so simple as to just, say that, a small law firm has a 4 multiple or a 5 multiple. It's that it's this, you have to find out literally about all of the things that go into that and what makes up that, the revenue and the expenses, and how many people work there, and is one person bringing in 80% of the work, and all of those different factors factor in that
Yeah,
you
and
need
it's
to
the
look at.
quality, of those earnings as well. Like, let's, for example, like a dermatology practice, the rise in Botox injections and cosmetic procedures. If their income is mostly now cosmetic, non-insurance based money, that's might have a little bit more of a premium than versus a generic, dermatology practice that deals with insurance-based practice. So those are factors we consider as well. I mean, especially in the medical field versus, out of pocket versus insurance-based. Whereas the out of pocket, cosmetic, earnings might be more valuable than, the generic earnings. So that's, again, that's what it says. It's multiple factors we have to figure out. Again, the stability to that. Is it trending? Is it what, it's been long standing, that's where the
Right.
multiples come in.
You're looking at the history of the earnings also. Did they have, one good year? Are they pretty steady? Are they climbing? Are they going down? All of those things go into those values of those small firms. Any other questions? All right, well, we thank everybody for joining us. We're wishing everybody from KLG, everyone out there, happy holidays, happy and a healthy new year. And we look forward to joining these again next year. Again, you'll get something to fill out. If you could fill those out and let us know what topics you want to know. If you have anything specific. We have one last question. No, we have a thanks, gents. Well done. Well, we appreciate that. Thank you very much for joining us, and
And again,
everybody.
feel free to reach out to us anytime.
Yep. If you ever have any questions. So have a good one, everybody.
Thank you.
Thank you. Bye.